Every empire believes it's different. Rome thought its roads would last forever. Britain believed the sun would never set on its colonies. And America? It believes debt has no limits, but history says otherwise. Every great power that thought it could borrow endlessly eventually hit a wall. Today, America sits atop more than $34 trillion of debt, and it is growing faster than its economy. Interest payments alone are now larger than the defense budget. The question no one wants to ask is simple. How long before the bubble bursts? Before we dig in, I want to hear from you. Drop a comment below. Where are you watching from, and what time is it right now? It's always fascinating to see how far this community reaches across time zones and continents. And if you're new here, hit that subscribe button and turn on notifications. These deep dives take a lot of research, and your support helps us keep exploring the stories your economics textbook forgot to mention. Now, let us unpack how America's senior most debt machine became so massive that it now fuels and threatens the entire global economy. Because what's coming isn't just a fiscal crisis, it's the possible end of an era. To understand how we got here, we need to separate two ideas that often get blurred together: debt as a tool and debt as a trap. In small doses, debt is productive. It builds roads, funds education, and helps businesses expand. But when governments treat borrowing like a substitute for growth, the tool becomes a weapon turned inward. The United States once used debt strategically. During World War II, for example, borrowing to build an industrial juggernaut. But since the 1980s, something changed. Debt became permanent policy. When Ronald Reagan took office in 1981, the U.S. national debt was under $1 trillion. By the end of his presidency, it had tripled. Reagan's team argued the growth would pay for itself, but the pattern that began then never stopped. Clinton balanced the budget briefly in the late 1990s, but after 2001, deficits exploded again. Wars in Iraq and Afghanistan, tax cuts, financial bailouts, stimulus packages, and now pandemic relief. Each crisis justified another round of borrowing. Each decade made it easier to forget what discipline even looked like. But here's the problem: interest. Debt isn't free. In 2024, the U.S. paid nearly $900 billion in interest alone, more than it spent on Medicare or defense. That number will soon cross $1 trillion if rates stay high. And here's the vicious cycle. As debt grows, so do interest costs, forcing more borrowing just to pay the interest. Economists call it a debt spiral. History calls it the beginning of the end. We've seen this pattern before. In the late 18th century, France borrowed heavily to fund wars and royal luxuries. By the time of the Revolution, interest payments consumed over half the national budget. The state could no longer tax or borrow enough to keep up. The result was collapse. In the 20th century, Britain faced a similar reckoning. After 2 world wars, its debt exceeded 250% of GDP. The pound lost its global dominance and the empire began to unravel. Now, America's debt to GDP ratio hovers near 120%. Not yet catastrophic, but trending upward fast. And unlike post-war Britain, there's no empire left to sell off. What makes this moment unique is the illusion of control created by the dollar's global dominance. The United States issues the world's reserve currency. That means when it borrows, it does so in its own money. Other nations, from China to Japan, hold trillions in U.S. debt because they need dollars for trade and reserves. As long as the world trusts the dollar, the game continues. But trust is a fragile thing. In 1944, the Bretton Woods Agreement made the dollar as good as gold. In 1971, Nixon ended that link, turning it into pure fiat, backed only by faith. That faith is what allows Washington to borrow without immediate consequence. But history teaches that every fiat system has a breaking point. Rome's silver denarius once became bronze. Revolutionary France's assignats became worthless paper, and Weimar Germany printed itself into chaos. The timeline changes, but the math never does. Let's look at what's driving the current explosion. The U.S. government now borrows over 25 cents of every dollar it spends. Even during periods of economic growth, deficits remain. This is unprecedented outside of wartime. The reason is structural. Entitlement programs like Social Security and Medicare, growing military costs, and tax revenues that no longer keep pace. Politicians promise benefits without raising taxes, then borrow to bridge the gap. It's a strategy that wins elections but loses centuries. Some argue that America's debt doesn't matter because it owes the money to itself. But that's misleading. Roughly a quarter of U.S. debt is held by foreign investors. Another quarter is held by the Federal Reserve, which creates dollars to buy bonds. This is effectively money printing under another name. It works as long as inflation stays low and confidence stays high. But when inflation rises, as it did after 2020, the Fed faces a paradox. To fight inflation, it raises interest rates. But higher rates make debt more expensive, deepening the spiral. Sound familiar? It should. In the 1970s, America faced stagflation, high inflation, and weak growth. The Fed crushed it by raising rates to nearly 20% under Paul Volcker. But back then, debt levels were small. Today, the same move would bankrupt the government. Every 1% increase in interest costs adds hundreds of billions in new expenses. The levers that once worked no longer do. This is why some economists warn that the real crisis one, to be sudden like 2008, it'll be slow and political. Over time, the government will choose inflation over default. Printing money quietly erodes debt, but it also erodes savings. It's a soft default, paid for by the middle class through lost purchasing power. Hyperinflation isn't likely, but gradual devaluation is almost certain. Now here's the uncomfortable question. How does this story end? History offers three outcomes: reform, default, or inflation. Reform means cutting spending and raising taxes, which no politician wants to do. Default is politically suicidal. That leaves inflation, the invisible tax. It's how empires unwind without admitting failure. And if you think it can't happen here, remember, every empire said the same. The most dangerous thing about debt bubbles is that they don't burst all at once. They erode confidence slowly, then suddenly everything happens at once. It's like watching cracks form in a dam. For years, the water level rises, pressure builds, and politicians assure everyone it's fine. Then, in one fateful moment, the wall gives way. That's the paradox America faces today. Every indicator, from bond yields to credit ratings, is flashing warning signs. But because the collapse hasn't happened yet, the system keeps expanding. Wall Street calls it resilience. Historians call it denial. Let us step into the mechanics of the system to understand why the bubble has grown this big. The U.S. government funds its spending by issuing treasury bonds, IOUs bought by investors, banks, and foreign governments. For decades, these bonds were considered the safest asset in the world. They powered everything: retirement funds, corporate balance sheets, even central bank reserves. The assumption was simple: America always pays. But what happens when even safe assets start to look risky? In August 2023, Fitch Ratings downgraded U.S. debt for only the second time in history, citing erosion of governance and an unsustainable fiscal trajectory. Translation: political dysfunction has made the world's largest economy look unstable. The U.S. government nearly defaulted that same year because Congress couldn't agree to raise the debt ceiling, a self-imposed limit that has been raised 78 times since 1960. Every few years, lawmakers reenact this same drama. One side demands cuts, the other warns of disaster, and in the end, they both agree to spend more. It's political theater, but one day the audience may stop clapping. Here's the core issue. America's debt isn't just a number. It is the foundation of the global financial system. U.S. treasuries serve as collateral for trillions of dollars in loans. When confidence in that collateral fades, liquidity dries up everywhere. That's exactly what happened in March 2020. As markets panicked, investors tried selling everything, including U.S. bonds. The supposedly safe market froze. The Federal Reserve had to step in and buy over $1 trillion of debt in weeks to prevent collapse. In that moment, one truth became clear. The Fed is no longer just managing the economy. It's the buyer of last resort for the government itself. That is the quiet shift no one votes on, a financial regime where the central bank funds deficits indirectly, printing money to keep yields low. Economists call it monetary dominance, but in practice, it's a trap. The more the Fed intervenes, the more dependent the system becomes. Stop and yields spike, continue, and inflation roars back. There's no clean exit. Now, imagine this. What happens if the world stops believing in the dollar? For decades, nations like China and Japan have bought U.S. debt to stabilize trade. But as relations sour and deficits explode, that trust is waning. In 2024, foreign demand for treasuries fell to a 20-year low. Even longtime allies are diversifying into gold, commodities, and regional trade systems. The BRICS nations, Brazil, Russia, India, China, and South Africa, are openly discussing alternatives to the dollar. Individually, they can't dethrone it, but collectively, they can chip away at its dominance. And when global demand for dollars fades, America loses its greatest privilege: the ability to borrow endlessly without consequence. Let's look at history again. The British Empire enjoyed a similar advantage in the 19th century. The pound sterling was the global reserve currency. London financed trade, wars, and railways across continents. But after 2 world wars and mountains of debt, the system buckled. By 1944, the pound ceded its throne to the US dollar under Bretton Woods. The transition was gradual, but inevitable. Confidence had moved elsewhere. Today, the same dynamic may be quietly beginning with the dollar. But here's what makes America's debt crisis unique. It's self-inflicted. The U.S. isn't being invaded. It isn't rebuilding from war. It's drowning in debt because of policy choices. Borrowing to fund everything from tax cuts to entitlement programs without political consensus on how to pay for them. Every side blames the other, but both parties have added trillions. Debt is now the one true bipartisan issue. Not because it's solved, but because it's ignored. To see how fragile the balance has become, consider this. By 2030, interest costs could exceed all discretionary spending combined. That's defense, infrastructure, education, science, everything. Imagine running a household where credit card interest costs more than rent, food, and transportation. That's not budgeting, that's survival mode. So what's the end game? There are 3 scenarios, and none are painless. First, financial repression. This is the stealthiest option. The government keeps interest rates below inflation, slowly eroding debt in real terms. Your savings lose value, but the debt becomes cheaper over time. It's a hidden tax. This tactic was used after World War II to shrink massive war debts. It worked then because inflation was moderate and growth was strong. But today, with an aging population and weak productivity, that formula is harder to repeat. Second, austerity. This means slashing spending or raising taxes dramatically. Europe tried this after 2010, and it led to protests, stagnation, and political chaos. In America, where every spending cut is political suicide, austerity is unlikely, but not impossible. The math may eventually force it. Third, inflation or default. If markets lose faith and refuse to buy new bonds, the Fed will step in again, printing dollars to fill the gap. That's the moment confidence truly breaks. Once people realize money is being created just to service old debt, the rush out of paper assets begins. It's not dramatic at first. A slow leak, a shift to real estate, gold, or foreign currencies. But over time, the dollar's purchasing power erodes. That's how hyperinflation begins. Not with a bang, but with denial. The tragedy is that every warning sign is already visible. Debt growing faster than GDP? Check. Interest payments exceeding defense? Check. Political paralysis? Check. A central bank monetizing deficits? Check. In the 1980s, economists warned that once debt crosses 90% of GDP, it starts to drag on growth. Today, America is 30% beyond that threshold. Yet the narrative persists. We're different. We're America. But that's exactly what every empire believed before decline. Rome thought it could devalue its silver forever. Spain thought gold from its colonies would flow endlessly. Britain thought global trade would sustain its currency forever. Each was wrong. The final irony? The US dollar's dominance allows America to export inflation abroad. But when that dominance fades, inflation comes home. And this time, there's no one else to bail it out. When debt becomes the foundation of an economy, every crisis becomes existential. It's no longer about fixing numbers. It's about preserving belief. Because in a system built on credit, faith is currency. Once that faith cracks, everything else follows. And that is the terrifying part. The collapse of a debt bubble isn't just financial, it's psychological. Imagine waking up one morning to find the dollar down 20% overnight. Import prices spike. Gas, groceries, electronics all cost more in hours. Yields on U.S. Treasuries skyrocket as investors demand higher returns to offset risk. The government faces a brutal choice: pay higher interest or print more money. Both paths lead to pain, either a fiscal implosion or runaway inflation. The markets panic. Foreign holders dump bonds. The Federal Reserve, cornered, steps in again, flooding the system with liquidity. For a few weeks it works, then confidence breaks for good. This is how hyperinflation begins, not because people lose faith in numbers, but because they lose faith in institutions. The first to react are the wealthy and well-connected. They move assets offshore into gold, real estate, or foreign currencies. Next come businesses, adjusting prices daily to keep up with costs. Then, the middle class, watching savings evaporate, scrambles for tangible goods, food, tools, anything that holds value. Finally, the poor are left with worthless cash and no safety net. That's not fiction. It's Weimar Germany, 1923. It's Argentina, 1989. It's Zimbabwe, 2008. And though America's scale is far greater, the math doesn't care about borders. When debt outpaces production and trust erodes, the outcome rhymes. Every single time. Now you might think, the US could never fall that far. It's the world's reserve currency. But that is what Britain said in 1945. That's what Rome believed when its empire stretched from Scotland to Syria. The truth is, empires fall not when they are conquered, but when they overextend, when the cost of maintaining dominance exceeds the benefits, when they choose short-term comfort over long-term discipline. Let's rewind to 1907, a forgotten panic that almost destroyed the American banking system. Back then, one man, J.P. Morgan, personally orchestrated a rescue, using his fortune to backstop collapsing trusts. That crisis led to the creation of the Federal Reserve in 1913, a central bank meant to prevent future meltdowns. But over time, the Fed's role expanded. From stabilizer to manipulator, from lender of last resort to the engine of the entire system. And with each intervention, markets learned one lesson. Risk doesn't matter because the Fed will always step in. That S moral hazard, and it S the beating heart of today, S debt bubble. Every bailout, every stimulus, every emergency spending bill reinforces the illusion that the system can defy gravity forever. But gravity always wins. History's longest bull markets, strongest currencies, and richest nations all share one trait. They forget that prosperity built on credit is borrowed time. So what might the breaking point look like for America? It could start quietly. A weak treasury auction, a ratings downgrade, a spike in bond yields, a sudden drop in the dollar, the ripple spreads, stocks fall, banks tighten lending, credit freezes, politicians argue. Again, the Fed launches new programs, but this time the medicine no longer works. Investors see the move not as confidence, but desperation. Within months, inflation surges beyond control. Wages can't keep up. Protests erupt. Populist leaders promise easy fixes. More printing, more subsidies, more blame shifting. None of it solves the core issue, that the nation borrowed against its future for decades, and the bill has finally arrived. And here's where history turns dark. When currencies collapse, democracy rarely survives intact. In Weimar Germany, economic chaos paved the way for authoritarianism. In ancient Rome, inflation fueled class warfare and civil strife. When money loses meaning, people seek order, no matter the cost. So yes, America's debt bubble could burst slowly, a decade of stagflation, declining living standards, and financial repression. Or it could end suddenly, a shock that forces global realignment overnight. Either way, the old world ends and a new one begins. But maybe, just maybe, this story doesn't have to end in tragedy, because history also shows moments of rebirth. After the Panic of 1837, America rebuilt with sounder banks. After World War II, nations came together to forge Bretton Woods. Flawed, yes, but visionary. After the 1970s inflation crisis, leaders took painful steps to restore credibility. Every collapse holds a lesson, if it's faced honestly. And that's the real question. Can America confront its addiction before the crash? Can citizens demand accountability, transparency, and restraint, not just from politicians, but from themselves? Because at its core, debt is a mirror. It reflects not just spending, but values. We borrow because we want more today than we're willing to earn. Governments do the same. The bubble bursts when belief in tomorrow disappears. So maybe the real danger isn't the numbers, it's the mindset. The faith that someone else, someday, will pay. But if history has taught us anything, it's that someday always comes. And when it does, it doesn't care how rich the nation once was or how powerful its military is. It only asks one thing. Did you build on debt or on discipline? So now I'll turn the question to you, from wherever you are watching. Do you think America can deflate this bubble peacefully, or has the fuse already been lit? Drop your country and your time zone in the comments, because when this bubble bursts, it won't just be America that feels it.